Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, diagonal spreads. These are actually the one I'm most excited about as a tool to take advantage of volatility and price movement. The neat thing that they have is you can really just use volatility and all of the different Greeks involved with FX options. You can use a bullish spread that has a negative, sells front month high vol and buys back month lower vol and make it go. And if the market goes your way, you can absolutely blow things out of the water, all right? Now, this is a spread in, I believe, CDD again, right?
That looks right, Mark.
Okay. And I pulled this up. This was from... we'll go look at today's, and what I want you to notice is, take a look. The yellow is the back month, green is the front month. Okay. Yellow is the front month, green is the back month.
Yellow
all right.
front. Yep.
Yeah. Take a look at what is happening. All right, with the skew. Here is 104. Okay. Here's 104. We want to put on a bullish spread. And then here we are at 106.29. All right, what do you think we could have done to make this spread better? Well, let's see how the vol moved, okay? If we bought back month 104 calls, all right, we were buying the cheaper vol, right, in relative terms, in implied volatility terms. And if we sold, let's say, the 106s, we were selling relatively expensive vol. Then when this thing goes our way, what has happened? Well, look, the green is now the relatively more expensive, and the yellow is now the relatively less expensive that we sold. So we've actually taken advantage of both ends. So let's compare real quickly how those two vertical spreads compared with each other. Okay? How did those two vertical spreads in CDD, all right, so we're going to June, okay? How did those vertical spreads perform? So we're going to go to June 2006. We're going to compare the we're going to June. I think we're going to June. What the? Here's the 7th. Oh, the 4th. We're going to the 4th. All right. So here's the 4th when we're sitting at, okay, oh no, perfect. So we're going to the 3rd, okay? And here is the 3rd when we're sitting at 104, all right? And the first trade we're going to look at is buying a 104-106 call spread. And it's a nice trade. You're only paying 70 cents. You're picking up, you're picking up positive skew. I like it. I don't hate the trade. If you're bullish, hey, more power to you. All right, it's not a bad trade at all. Okay, so let's convert. And what the heck? Didn't I fix all this?
I thought you did, Mark.
Yeah, I did. Son of a gun. Goes to show you. And we'll go in and fix all this. There's nothing like putting on a 10-lot trade and then having the model read that you're immediately down $260, which is ridiculous.
Yeah.
I can promise you the ISE will not give you fills that bad. All right? All right? So here we are, and then we go. We're at 2:30 in the afternoon on Thursday, 3:30 Eastern Time, and then here we are on Friday. And we get that big rally, and our trade makes, it does well. It makes $440. Okay? We like that. Okay? That's fine. I really like that trade. All right, so now what's going to happen with our experiment? And when I ran through this earlier, it worked like a dream. Let's keep our fingers crossed here, okay? All right, so then we're going to sell. We're going to do the same spread, but now what we're going to do is put on a diagonal. We're going to buy the 104 calls in July, and we're going to sell the 106 calls in June, okay? And obviously in this case, it didn't show exactly what I was looking at earlier, but it does remarkably well. Okay, you end up making $340 on the day, whereas if I had done the trade at 2:30 in the afternoon, I am sure that this works. All right, because I ran through it, and the numbers came out pretty well. In either case, though, the neat thing going is that you've really gotten a chance to buy cheaper vol and sell expensive vol, and maybe we go out to the 7th, and we'll see how this trade continues to perform. And now you're up $390 on the 7th, so we're doing better and better, all right? And obviously then we turn around and you should have gotten out. Goes to show you that when a trade goes your way, take the money, right? I think we've all learned that lesson. And trade log. And I'm going to, we'll walk through this for a couple of days to see how it looks on the 7th. Let's see where this is on the 7th, because I think that this ends up, well, on our trade one, we were up $390. This trade, we end up 400 and, about the same. And then if we continue on to the next day, you give it all back when it rolls back. So in the end, the numbers didn't exactly match up to the way I had priced them out, but when you take advantage of that volatility, you're really going to see opportunities to, one, kind of actually have more stable credit spreads. If you're making a bet, because you've got a little less gamma from the back, you're actually going to be I think it's going to be a sturdier trade if you're wrong. And then the volatilities will go in your favor.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.